I get DMs every day. How do I become a real estate investor? Right? Such a vague question. How do you answer that? And I launched a video today. I'm like, man, you guys are asking everybody to be your mentor, but you need to come to them with what kind of value you're going to bring to their organization. And it's not just a handout.
Welcome back to Real Investing, where we talk about the real investing for everyday investors, the real investing for everyday investors.
It works.
Tim Arridge.
Ryan Harper.
And we're joined today by my buddy from the Boardroom Mastermind, Marcus Robbins. Thank you for flying up from San Antonio.
I appreciate it.
What's that all about? Why didn't you drive?
Man, anything over Houston, I'm out. So if it's 3 hours is kind of my max. And so I know realistically, I was actually timing that on the way to the airport that I realistically probably could have been here much quicker had I driven in. But I can work on the plane, and kind of hang out there. So appreciate you.
You could drink on the plane.
Yeah, I didn't have any. I knew coming with you guys that I would probably have some beverages afterwards, so I saved that till later on.
So San Antonio, Central Texas, kind of the Golden Triangle, if you will. Mobile home and RV park development? So not just mobile home, not just RV park, both?
Mobile home and RV park development, and we're acquiring those parks as well, too, and renovating and stabilizing. And
that doesn't make sense to me because you look too pretty for mobile homes and RV parks.
So the story, I've got kind of the yin and yang.
That was with respect.
Man, I know. I don't have my cowboy boots on today. I'm hearing the big D. The story, I've got the yin and yang with my parents. So my dad was a bull rider, rodeo, he was the cowboy, he was a rancher. And then my mom was the city gal. And they kind of met like the bud and sissy type deal, right? Urban cowboy, and so
he got a trailer park in the urban cowboy.
So I had to make my dad proud, right? And so I'm like, Dad, look, I own trailer parks now. But so definitely not the average, but we'll talk about this today. But most of the operators, especially the parks that we acquire, they are your stereotypical mobile home and RV park operator, right? They're not as sophisticated on the business side, which helps us on the value add side. But yeah, they're mom and pop, they're blue collar. They generally have had this land. It's multi-generational land. So they've owned this land forever, and on a whim, they decide to, start this business.
This stuff has been so popular since COVID.
It's crazy.
Is it oversaturated? Does the business just suck?
No, what sucks is now mobile and RV is cool. It's mainstream now. Private equity is gobbling up all the mobile home parks. And so I've got in this in 2012, so I've been doing this full time, nothing but trailers, RV and mobile since 2012. And back then, people were like, what in the hell are you doing? Like mobile home parks, why would you want to own a mobile home park? To answer your question about COVID, there was a boom during COVID, and that was more of your travelers. When most people think about RV parks, they think about a commuter. They think about a short term, let's take the family to the lake or to the river, to the beach, and that's completely opposite of the model that I do. So we kind of buck the normal RV. I'm looking for longer term RV parks, extended stay guests, because it's stable cash flow.
So I'm ignorant when it comes to this, but I know a little bit. Mm-hmm. Like the RV parks, the mobile home parks, the real estate is the real estate, but the home, is it auto or is it deemed part of the real estate itself?
So 2 questions there. Let's, do you have something to chime in?
There's so many jokes I want to make, but I'm not going to.
Do it.
Do it.
It's, as long as it's at his expense.
Will they be funny?
Yeah.
No. But they will to me.
So attacking that question, you were asking as far as the homes. So RV and mobile, there's a big difference. When I talk to some of our guys that are looking to be LP investors with us, biggest misconception is they don't know the difference between. They just think trailer, so they don't know the difference between an RV and a mobile home.
Okay.
So is that part of your question?
Well, I didn't know I was asking that question, but apparently I am.
You were.
I didn't realize there was a difference between RV and trailer.
Let's hit that one, because that's one of the biggest questions. So you've got an RV, which is a recreational vehicle. This is a conventional thing that you'll see people pulling down, with an F-250, and it hooks.
He pointed at me when he said pulling an RV. That's fine. So, I actually own an RV.
There you go. I'm speaking to my audience
and
here.
a 3/4 ton truck. So
there you go.
You hit twice.
It's the beard, man. So an RV is a recreational vehicle, something that somebody can hitch.
Like a campsite or something.
Anybody can pull it down the road. You can pull it with an SUV, you can pull it with a truck.
We'll call it an Airstream. Like, that's the most
That's the most
one.
popular. And then a mobile home is a fixed structure that somebody's using as their primary residence.
Right.
Now, people, and we'll get to this in the conversation, the evolution of the conversation that I like to educate people that are not familiar with the asset class is that people are now living in RVs from maybe it's a minimalistic lifestyle approach, or it could be affordable housing, commuters, people that are insurance adjusters, traveling nurses are like our bread and butter. Traveling nurses, contractors.
Is it kind of like the van life people, but maybe they don't want to live in a van?
Well, I'll tell you. So my cousin in Arkansas, he runs
I've
a
got a
big
joke there.
dealership. Trust me, I'm going somewhere.
Cousin.
Well, his wife is an ER nurse, and every couple years they'll do like the traveling nurse thing.
Yeah.
And instead, they get a per diem, and instead of going and paying that per diem on the hotel, my cousin hooks up to the RV, finds the nicest park in the area because they don't want them to be near, like in Texas, there's a lot of meth in some of these parks. He finds a nice park and takes his wife down there, and that's where she stays when she's there 3 or 5 nights a week. So
so you're exactly right. So mobile homes being a fixed structure, and I segued to saying that people are still living in RVs, but going back to mobile homes. You've got RV parks, conventionally known for vacation-type rentals, short-term. They come in for the weekend to go to the beach. Mobile homes, primary residence, somebody lives there. As an investor, just speaking to guys, if you don't know much about the asset class, the reason private equity has aggressively gone after mobile homes is the stability of the cash flow. Because, a sophisticated investor is not going to own, if you own a park, you don't want to own the mobile homes. You don't want to own the RVs. You want to own the lot. So all we're responsible for is the horizontal development. We're responsible for the utility setups. And so as an investor owning these parks, if you have the lot that you own, they rent the lot. Well, for a mobile home, there's a lot of stability in that income because it costs $15,000 to $20,000 to move a mobile home into a lot, get it set up, get it skirted, and that demographic generally does not have the money to move that home out of there.
So it's a very immobile home.
It's very. You have to you have to pull tech stop permits. You have to hire a professional.
But you were just saying that the private equity, they don't, or maybe not the private equity, but typical investors want the stability of the lot, but not the building itself.
Correct. Yeah.
So are you just, you let somebody else rent the building or own the building and you own the lot?
Yeah, I made the mistake
both,
a long time ago when I've been doing this. I'm 43 now, so when I was 30, I started. And I'm like, being greedy, going, damn, if I own the home and the lot, I'm cashing in. And then you have taxes and insurance and evictions and
maintenance.
So all of that stuff. So they own the homes, we own the lots.
You brought it up, evictions, mobile home specific. How do you evict them from the lot? Do you have to spend the $15,000 to hook up and drag the thing away?
If it's left there, and then there's other legal processes where you can go through that you can eventually retain ownership of the structure there. A lot of times, depending on the type of asset, if it's an A asset class, you're gonna have a nice home. If you have a C junkyard dog asset class, a lot of times we have to end up demoing the home. So we'll demo it on site, or my biggest trick that we do is we'll just post it on Facebook and you'll be surprised at the stuff we just post, hey, free mobile home. It could be a 1980s mobile home, just a junker, and they'll come and pick it up, they'll renovate it, pull out all the flooring, plywood down, and so they'll come and pick it up for free.
Take it to their dear lease.
Man, hey, make it their house, right? So,
well, because a lot of the audience probably isn't single family, and I am primarily on the operator side. When we evict the personal property that's left behind, we have to stick it on the curb. Mm-hmm. Obviously, you can't stick a mobile home on the curb. So,
drag it to Walmart, drop it off. We've done that with RVs, which is highly illegal, but yeah.
He has not done that with RVs.
Yeah.
All right, so eviction, they don't pay you. You own the dirt. Their personal property's there. You got to go through some court proceedings. But it's like you said, if they're worried they could lose their house, that asset that they own, they're going to try to find a way to pay your lot rent.
Yeah, what conventionally happens, if they can't pay the rent, they get behind. Or if going back to the topic of that, how the investment being a stable investment because of the fixed structure and the cost associated with moving that structure. So if they get transferred for their job, they get laid off and they can't pay their bills, normally what will happen is a family member will come and take over their payments and assume the lot rent. Or they'll put it on Facebook Marketplace and say, hey, I've got my home for X amount of dollars. You assume lot rent for XYZ mobile home park. And so it just stays there. So a lot of times we don't see the in and out. We generally can try to figure out a way to, get them out of that situation.
So in single family, there's the 1% rule. What is there a rule like that with this world in terms of like what you would rent this lot out for?
Is it like per acre, per lot, per foot?
Talking about just dollar amount.
So like, and I know the 1% rule is probably old hat and probably not even in the hemisphere of reality anymore, but
show your gray hair, just say it.
Typically, the ARV is $100,000, you're going to rent it for $1,000. So is there something like that would translate into this world?
There's not, because you're comparing ARV to the rent price. We own a lot, so we're generally we're generally not dollaring out the price of the lot. I will give you like San Antonio, Texas, for example. Average lot rent's probably $575, $600 for just the lot. Then
they utilities too?
No, they pay all their utilities. So I'm going to blow your mind. The single family guys are going to start knocking on my door here and blow me up on Instagram. But they pay, dude, it's the closest thing to self-storage. It's just a much greater return. Now, with self-storage, you don't have to deal with a tenant, right? But, I mean, all we're responsible for is we sub-meter the water. We use Metron, that's a company that we sub-meter all the water, passes through directly to them. They're self-billed with mobile homes, their electricity is directly, so they'll set up with like San Antonio CPS, City Public Service. They set up their account with the electric company. If they don't pay their electric bill, the electric company shuts off their electric. It has nothing to do with us.
So when you're building a park, and this is something I'm very interested in, you're really, as you're operating the park, your expenses are kind of limited to whatever any repairs and maintenance are for like the capital improvement type stuff on the land. So when you're putting in the electric underground, I would assume, you're just stubbing up and there's a meter there at that pad?
Yeah, two scenarios.
Do you call it a pad or a lot?
A pad lot. Pad lots. Everybody calls them different things. But there's two scenarios. You've got, because again, we're talking about RV and mobile.
Yeah, well, let's stick on mobile right now.
They're very similar. But if we're talking just mobile, with mobile home, you'll stub up the utilities just like you would for single family, and then they will get somebody to set the meter. So you'll provide, the beautiful part.
And then they just plug in, right?
Nah, a little bit. Yeah, that's an RV, so we'll get there.
Oh, yeah.
But like I'm currently building a 100-lot mobile home park, Class A park, luxury community, which is kind of different than some of the stuff that I've done in the past. I found land that was zoned OCL, a whole nother topic about zoning we need to get into, because that's really the determining factor on can you and are you able to do a mobile home park. But so you'll stub everything up. They'll have to get their home transported in. You provide the pad, you provide the utilities. They have to get it transported in. Then they have to hire a company to then pull the wheels, block everything up. They do all of that. They're responsible for all of that. They have to hire their electrician. They have to get with the electrical company to set the meter. Then they have to hire the electrician to hardwire the home to the meter. Then they have to hire their own plumber to tie into our sewer system and to tie into our water as well. So we're providing stubs and everything for like a Class A newer community. When they buy a home, they'll generally roll in all the expenses for all the setup costs. So the transportation, the leveling, the tying down, the skirting of the home, the decks, the plumber, the electrician, and they're rolling all of that into their mortgage generally. So yeah, we provide the lot. They hook it up and...
I'm sorry, you just said mortgage?
Well, for their
well, I know some mobile homes are eligible for mortgages. Do people get mortgages on mobile home parks as well?
I was referring to buying, if somebody's buying their home from like a Palm Harbor or a Titan, one of those, and I don't even know if that's referred to as a mortgage.
I don't either.
I'm not a lender. But
I'm not either. I'm just a hard money guy.
But yeah, so it's, but they roll that all into their home mortgage payment.
They're financing.
Yeah,
we'll
correct.
just say that. They're financing.
Yeah.
So then I'm buying a mobile home. I know I want to come to your park. When I buy it, I roll all that setup cost into my financing. And so if I, like, to go back to what you said earlier, and then I want to learn the nuances between RV. If I want to move that at one point in time, I can't roll that into anything at that point. Now I'm paying all that out of cost. I got out of pocket. I got to like pay to get it disconnected from the sewer. I'm literally going in reverse what you just said. Pay to have it unhardwired, pay to have it unskirted, find the wheels and pay to have them put back on, unblocked, hooked up, and rolled out.
Stability.
Yeah, they're never moving.
Right. Yeah.
That,
exactly.
that thing is coming in and getting torn down eventually.
And that's what, well, I mean, depending on the classification of parks that we're talking about. But again, back to the PE stuff, right? Like that's why they're gobbling these up. When multifamily, I mean, I could shit on multifamily all day. Because multifamily, there's so many moving parts, right? You got so many moving parts. You've got all the capital expenditures. You've got all the unknowns. You've got all the structures. I mean, there's just much less moving parts with mobile homes.
And since you're building a park, you're kind of like, I would imagine, putting in a little bit higher quality type infrastructure under the ground or wherever you're putting it, because you know that's your only potential expense, right?
Correct.
It's like if you had to repave the road, that's on you. Mm-hmm. If you had to, if the underground electric broke, that's on you.
Yeah.
If the underground water broke, that's going to be on you. But the rest, you have like.
I'm horizontal.
I guess you got to take care of the trees.
Yeah, it's trees, common space type, those things. I'm horizontal. So it's all horizontal, common space, HOA type deals.
Yeah.
That's another thing. Like
we don't talk about HOAs.
Yeah, I don't get into
Not
HOAs.
a topic.
Is there a sweet spot on because I know you were talking about you're doing 100 or 200 plot new development. Is there a sweet spot on number? Like, is it 30? Is it 50? Is it 200?
Man, I started back in the day in 2012, and the first park I did was 80 lots.
80?
80?
80 RV park.
I think you say like 10 or less.
But then the first mobile home park I did, it was funny the way I got into, I was in RV first. I got into mobile homes as a byproduct of the neighboring property next to me. It was 4.5 acres. It came up for sale. There was a little country farm home on there. Came up for sale, and I didn't want to have somebody buy that property, and it was a common fence line. I didn't want to buy the property and throw parties and scare off my tenants. So I said, man, I'm going to buy that 4 acres, and I'll just renovate the house. I'll rent the house, control the land. I got in, weird story, don't want to get down a rabbit hole, but got into mobile homes because of that 4 acres that popped up. I wanted to control my neighbor, okay? Then the oil field went from 125 a barrel back in 2012 to like 16, or I think 2016, it dropped about $25 a barrel. Then all of a sudden, all the mobile home companies, all the drillers, they have these man camps. They have all these mobile homes that they house their guys in. They're residential mobile homes, 3 and 4 bedroom mobile homes. I went and negotiated with them and bought these homes I bought homes that were worth $40,000 for $5,000 a piece. And I went to their yards and they had a sea of mobile homes. I mean, just all blocked up. And I went over there and I told them, I said, man, and I didn't have much money at the time, but I made them an offer. I mean, I'm a sales and marketing guy. Like that's my background. Made them an offer, about $5,000, $6,000, $7,000 a home to buy 20 or 30 of them. They laughed at me, called me back in a month. I said, we'll take it. So that's how I got in the mobile home
And then they said,
business.
as long as you can move it.
You move this shit.
And you were like, oh, crap.
Yeah, so.
But then you didn't have anywhere to move them to.
And I then hired an engineer. I platted that land, went through all the platting process. Weird thing is I do a lot of my stuff in major metros. This was right outside a major metro of San Antonio. So for this little dinky mobile home park, I still had to go through all the stuff that you'd have to do, like do a subdivision plat, like as if I was building a subdivision. So I did a subdivision plat, hired the engineer, had to hire a landscape architect. I'm like, I learned my lesson from my first park because it had tons of oak trees on it. And in San Antonio and any major metro, you're not allowed to just go start chopping trees down.
Mitigation.
You got to go through the mitigation process. And so I learned my lesson. So I looked at that 4.5 acres. I go, man, I could buy these mobile homes. I don't have a tree one on the property. But then I found out that if you don't have trees, they want you to plant trees on it. I'm like, fuck. I can't get this right. Like, there's no winning. So again, rabbit hole, but oil field tanked. They were liquidating their balance sheets. I capitalized on that, ended up owning the homes. And just.
You still own those today? Or,
I've sold, yeah.
Because I was going to say, reason I ask is you've alluded to the fact that you don't want to own any of that crap. You just want the land.
No, yeah. And I've sold those. 2021 came around, cap rates are compressed. I had brokers knocking at my door. I built up 4 parks at that time. 4 parks were paid for. I owned all of these for free and clear myself. I've never had any LP partners until 2024, which is kind of how Tim and I met. He's been giving me advice on that side. But 2021 came around, cap rates compressed. Broker said, man, people want to buy these assets. I said, go away. They're cash flowing a couple $100,000 each and paid for, and I had management running them. And then they gave me the offers when cap rates compressed and money was cheap, and I was like, fuck, let's go. And a week later, I had them all sold. So I sold 4 properties, and then life changes, right? Because then I turned from an operator that had a staff that had great cash flow to now then segueing into learning how to become a good steward of that capital, right? Like how to wealth preservation, tax strategy, and that's a whole nother rabbit hole. But I had to shift everything.
But it's important because when you bought these, it was all, and I've heard your story in long form. I mean, you were out there pushing a lawnmower, mowing these places. You were like meeting people and doing some of the construction work. And I don't think you even probably knew there was an exit, much less was thinking about it.
No, not at all.
And then there's this large number that had multiple commas in it. And you're like, okay, what am I going to do? You clearly figured out you knew how to do that, so keep doing that. Maybe talk about the shift in asset strategy. We'll leave the tax stuff out for someone with disclaimers. Huh?
What's that?
What? The tax stuff? Oh.
Yeah.
Just kidding.
What I don't
I'm kidding. I'm kidding. I'm kidding.
Yeah, so I mean that, again, you're exactly right. Like without getting into my history, right, I had a sales and marketing company. I was successful, making really good money from the ages of like 19 when I dropped out of college to 30 years old. And when I was 30, I'm like, man, I was in a transactional business. I was driving a Porsche, wearing a suit, thought I was the king of the castle, and had my first son at 30. I said, man, I don't want to be working 80 hours a week in a transactional business where if I'm not grinding and my sales guys aren't cranking, I'm not making money. If I go on vacation, sales dip. And so that's how I got into this side. But yeah, when I sold those in 21, it was just, shifting the strategy on, like you said, it was the difference of being an operator versus learning how to, or what's the old saying, not working in the business, but working on the business, right? Like I had to go and then sharpen my axe on the tax strategy. I didn't understand leverage at the time, man. Remember, when I left transactional in 2012, marketing and sales, all I gave a shit about is having recurring revenue. And I had built that.
You were just using your own cash to do it, right?
Yeah,
like you'd saved up some money and...
I bootstrapped the hell out of number one. I did, to your point, without getting into that, bootstrapped the hell out of number one, was wearing a Porsche, sold the Porsche, bought an old Chevy Tahoe, took out a home equity loan, borrowed money, and I was the maintenance guy. I did mow the grass. I cleared the land. A buddy and I, the first park, we had 2 chainsaws. It took us months to clear the land. I mean, it was 11 acres. We had 2 chainsaws, and I'm not a handy guy. I mean, you pointed out very frankly that I don't look like a guy that would be I'm not a lumberjack, but.
I didn't say that. I was just alluding to the fact that typically in your line of business, it's more of the Corey Thompsons, who is a client and a friend.
Yeah.
Who's very rednecky.
Rednecky.
Yeah.
That's a good word.
So to fast forward now, cap rates were really compressed in 21. Mm-hmm. They are not anymore.
No.
Are you now thinking build these while they are not compressed, time it for when they get compressed again, and just exit again?
Yeah, so the strategy right now, we've started acquiring a lot of these mom and pop, and really, so we're acquiring existing parks and we're building parks. In my older age, being 43, like I had a lot more energy and a lot more time. I didn't have 2 kids, and all of this other stuff going on. So I could do all of that back then. Now, acquiring is the fastest way for me to scale. We've got, as you know, I think we've closed on a park in Lake Travis in Austin a few weeks ago. We've got 2 more that we close on in another month. They're all fully funded. Cash is ready to roll. We're developing one of those parks, and then I'm also expanding some other ones there. So to your question is, yeah, we're foot on the gas as far as acquisitions because of our creative strategy. I mean, we're vertically integrated. We go directly to sellers. I don't buy anything on market. I've never bought anything on market. And so we're going direct to sellers. We're negotiating extremely good terms, owner carry terms. We're negotiating interest only. Generally, it's a 5-year IO. Max I'll pay on interest right now. So when most people are sitting on the sideline in the multifamily world, I'm buying these assets, I think it'll be $4 million, $5 million assets at 4%, 5% interest with 20 to 30% down. And I'm also negotiating an interest-only period for that 5-year IO, so it increases our cash flow out of the gates. We're able to pay cash flow distributions to our LPs out of the gates day one, within 30 days. And again, to your point there, yeah, cap rates are, not compressed right now, right. But the terms we're negotiating, it will work out for us when things shift.
When you're raising funds, are you raising funds for like per investment per park, or are you putting the fund together like, hey, this fund is going to go out and buy as many as possible?
Yeah, that will be the evolution right now. And again, Tim's helped me out with this, that right now 24 is the first time I've ever taken a dollar from any outside capital.
Yeah.
And so, recently right now we've got about $10 million, over $10 million in the past couple of months that we've raised. Deal specific though. Yeah. So everything is deal specific. I think I'll go after the fund model and look at that the biggest thing is for me is, once you have that fund, you have that capital, right? You're chasing yield. And I don't want to be stressed to deploy capital just to chase yield. And I'm not, by all means, I'm not very experienced with funds, but I know if I have that money, people are wanting a return on that money out of the gates.
One thing that I'm hearing so far that I think is really cool, and I like to say it a lot, I'm real estate adjacent. I'm not necessarily in real estate. I'm the adjacent side of it.
Is that what you identify as? Is that what
I identify as a real estate adjacent investor. No, but it's just like, I think, at least from my observations the last 15 years, the real estate investors tend to live in a bubble and they only see that bubble. And yeah, we're aware that there's people bigger, but I don't think people are aware how much bigger. Like earlier or last week, I had a meeting at the old Parkland offices. I don't know if you are even aware of those. Have you been there before? It's like, I know Rich. This is Illuminati Rich. And it's just like, you're there and you're like, I hope they don't get killed, But I'm just saying, it's just like, I mean, the amount of artwork that's there, and it's just like, but again though, like even in the boardroom or the Collective Genius was here. That's where, a lot of people are in town for that. And very successful real estate investors, and we live on our high horse of like, look at what I'm doing. It's like, bro, you have no idea. Yeah. So the compliment I'm trying to get to is the fact that you keep evolving and keep growing. I think that's really cool.
I appreciate it. And for me, to a fault, right? I mean, I'm we talked about being risk adverse, right? I mean, that's probably been one of the struggles that I've had in the past, but that's how I was raised. Like I was raised by a single mother, for almost my entire life, right? So I appreciate a dollar. I appreciate my dollars. And I also bootstrapped this from day one with my dollars. And so for me, when it comes to placing investor capital, the fund structure scares me at the current moment. But as I build out my team, and I can confidently say, hey, yeah, we can go take down $35 million in the next couple of months. It'll be good. But again, I don't want to be forced to chase yield just because, right? I want to continue to buy quality assets that fit my wheelhouse.
Have you read the Elon Musk biography?
No.
I would read that or audiobook it, only because and the reason I say that is because if you're afraid, I don't want to use the word afraid, but resistant or hesitant to take on outside capital and raise money like that, like the dude's rich as hell since he sold PayPal, but he still utilizes other people's capital.
Well, I think one of a compliment to Marcus that I think a lot of investors need to think about is be careful the advice you get. Yeah. A lot of advice that I've been lucky enough to be sitting in a room where he was getting it is go straight for the big fund and all that. And I think investors in general sit in a room and they hear these ideas and they try to apply it before they go through the necessary reps to be successful at it, right? Because you just said something very interesting. Even after PayPal, that's kind of a big thing, right? And so what I like about what he's doing with the individual asset capital raises versus go straight to the opportunity fund is he kept it really small and manageable at first, where he knew he could deploy it, generate return, and then find the next one, raise capital, deploy, generate return. And once you go, what is it, the 10,000 hour rule? Yeah. Once you've done something for 10,000 hours, then you're an expert. He'll get to that point with those, and probably about the time cap rates compress again, probably do a bunch of exits, and then start with a bigger stack of money and 10,000 hours of experience handling that, and then probably become the roll-up guy. He'll probably go find the 35-year-old Marcus and be like, look, I'm buying this from you when you turn 40, but for now, why don't you let me invest with you and be a part of your thing, and then I'll be your exit as well, right? Like, everybody wants to shortcut the evolution because they heard someone tell a story, and it's just like, man, time out, dude. Like, get your reps in first, because if you did land the big deal, you probably won't be able to manage it.
Yeah. And another thing to add to that is, just to build off what you said, is be careful the echo chamber you're in.
Ooh.
You know,
it's all surface level.
Well, because I mean, like you alluded to, like all the masterminds that you're in, and maybe somebody's regurgitating something, they don't actually have the experience.
They heard it.
They heard it from a guy who heard it from a guy
from a guru on Instagram.
But and that doesn't devalue the advice. It's just be aware and fully know what you're doing before you do it. But
and I'll tell you,
just realize there is an echo chamber effect.
We just finished our 2-day leadership offsite for Ternus. And I had an amazing facilitator there guiding it. And here's why. I've actually never run a company as big as Ternus. I've never been planning to grow something to $1 billion corporation. The facilitator that was there has done 2 IPOs, right? He has run many billion-dollar corporations. And his job was to help us plan properly, right? It wasn't his meeting. He kept telling me, he'd pull me outside, you're deferring to me a little bit too much. This is your meeting.
That's good.
This has to be you. But I'm here to help you get what you need out of the team, so that then I can help you tell your board what the plan is and how many millions of dollars you need to go hit the plan. But one of the things he said all day was, he goes, the main thing is the main thing. And I can't get it out of my head. I keep saying it to people.
What does that mean?
So I started Ternus because I was frustrated with the way lending had become too Wall Street-like for our friends and customers, right? And as a real estate investor, I only need dependent, consistent capital. I don't need cheap capital. I'm trained to ask for cheap capital because that's the only way I know how to measure what I feel, right? But what I really just need is, do you have the money, and will you show up with money the way you said you would when you said? Because, as you know, from our days working in the house buying business together, when the house buyer doesn't close, it's not the house buyer only that you're screwing. It's the title company that worked the tail off. It's the realtor that worked the tail off. And oftentimes it's a little old lady sitting in a U-Haul that turned off the utilities already in July in Texas, and she's got to move. Mm-hmm. And if that money's not there on that Friday, she is homeless all weekend, right? And so Jeff kept challenging me, the main thing's the main thing. Don't talk about your profit when you're planning. Talk about, how do we maintain speed? How do we keep our service levels where they are? Does that fit in the plan? Then, once you decide it fits in the plan, then you find out a way to make it profitable. So he started doing this so he could have time with his kids. He started doing this so that he could have consistency. He started doing this so he could own his own future. You can't give all that up just because you heard a neat thing, right? So he's keeping the main thing the main thing. He's taking on bite-sized chunks so that he still has free time. He chose to fly up this morning. That means he got to see his family before he left this morning, right? It's a big thing, right? Yeah. It's the main thing. So you're probably gonna get very tired of me telling people this, but I think if you keep the main thing, your business is wildly more successful, because that's where your passion lies.
And on that, I think, again, not to talk about the entire industry.
This is where we stop talking about real estate.
No, but it's just like, I've done a lot of events. Tim has done a lot of events. I'm sure you've been to a lot of events. And there's always a shiny new object effect when it comes to real estate investors. Yeah. And so the fact that you've been in this lane since 2012, and even though there's a little bit of variation or whatever, but you're still there, versus the typical evolution is, I wholesale real estate or single family, then I flip single family, and now I'm a multifamily investor because
Correct.
Brad Sunrock got me at an event.
Yeah, I mean,
What's
funny, to the main thing, like that comment, it's been nothing but RV and mobile. I own some triple net buildings. The only triple net building I own, I bought because I wanted the land behind it because it was attached to my RV park. And so now that building pays me 10 grand a month, but I just put 7, I only had room to put 7 lots, and those 7 lots pay me almost as much as that entire building pays me. So now I'm looking at just dozing the whole building. And it's a home health care. I should watch out. They're under a lease right now.
This is not an eviction notice.
5 years.
Hypothetically, allegedly.
But to your point, the main thing, like shiny object syndrome, all of my buddies, they might have been flipping homes or wanted to flip homes, and then all the gurus, multifamily became like the thing, right? Like you stop flipping homes because the real G's are out there.
Graduate into multifamily.
So when everybody was doing that, I just stayed my course, right? Because I understand, that's, since I've done the business from the inside out, since I've cut the trees, I've changed the breakers, I mowed the grass, I know the business just as good. I might not be the biggest guy out there, but I know the business just as well as anybody else out there because I've done every single level of it, and I've done it for 13 years. So.
Yeah, and I want to clarify, just because, we are talking about the main thing, and shiny object. What I'm referring to that is like when people completely change their entire focus. I do think it's important to have a diversified portfolio. Having a triple net building, having a multifamily interest, having stock in Tesla or whatever. I'm not in real estate, or I'm not an investor, I'm not a whatever. Advisor, thank you. It is important to try new things, and it is important to place capital in various places. But don't have a mental shift of who you are.
Well,
Yeah.
I'm a great example. If you actually go back to 2003, that's when I first started loaning money with Scott Horn. And we were a wholesaler, but he was a hard money lender, and we were wholesaling houses using terms. So I was like the only person, I think, ever that I advertised the house as $5,000 down, $1,800 a month for 6 months, and I'll give you $30,000 in rehab funds. It was a payment thing. But I've always loved lending, but I did want to get into multifamily. So I'm in multifamily, but I'm just an LP. I found someone that I knew, liked, and trusted, and I invested with them. I'm in triple net, but I'm not a triple net operator. I'm an LP.
Yeah.
I'm in oil and gas. Don't know how to drill for oil, but I found someone I knew, liked, and trusted, and I invested with them. And I say that because I'm gonna kind of rain on your parade, but then prop you up. We were at lunch before this, and you were talking about maybe you would offer some coaching because people are always asking you for advice. And everyone at the table, because some of them were coaches, were like, "Oh yeah, you should." I'm over there like, "Nope, nope, don't, no." But on the same token, I think I resisted a little bit at the boardroom earlier this year about you raising too much capital too quickly. But now you're raising capital, you're deploying capital, and you're doing quite well for your investors at that. So I think as you add on, be careful not to add on what's passionate. Just add on what's accretive to the main thing.
Well, add on, yes. But everything you just listed, if I looked at you, if the outside person looked at you, they would see Tim Herridge Ternus.
Yeah.
They're not seeing Tim Herridge oil and gas. They're not seeing Tim
Correct,
Herridge multifamily.
correct, yeah.
All these
That's
other
huge.
things. That's my point
That's
I'm trying
huge.
to make. Is
Diversification.
you are Ternus.
Yeah.
You are mobile home, RVs.
Ron likes to shimmy.
I like the shimmy. No, but my point is diversify, but don't lose focus of the main thing.
I have to add something on that point. In 2016, one of my buddies came to me and said, "Man, I've got this construction business. I'd like you to be a part of it. You've got a skill set that we could really use. We'll partner on these projects." And I partnered with him on the projects, and I made good money. But I made it a point to not let anybody know that I was doing that, because I wanted to make sure, not the main thing, but I wanted to be branded as one thing. That's it. And that way, when anybody thinks about a mobile home park, back in the day, they'd send me the mobile homes. I'd get deals, and I'd just sell those, when I was young in the business. But when somebody inherits a mobile home park, when they hear about their uncle selling an RV park, I'm going to be the only person that comes to their mind. And that was something that I set out to do. I can, hand on a Bible, said that to myself years ago. I said, you need to make sure that you brand yourself as this. Right. And that's essentially what I've done. And I continue to do now with Instagram and social media, is to push it out further than just my warm network there. So I think that's important, but I think it's important to diversify. But like you said, you find the operator, and here, dude, here's the cash, here's the keys. You work on it.
Well, I can give you advice. I can be your partner. I can show up to partner meetings. I mean, this morning, my wife and I had a partner meeting about our real estate company. But I'm not in charge of that anymore.
Yeah.
But I brought a level head to the meeting, and I said, look, we need to sell that one, keep that one as a rental, sell that one as is, and then I want to take the proceeds from these three, and we need to go buy a house in the M Streets that we're going to turn into another one of our corporate rentals. And that should give us, $600,000, like, kind of figure that out. And I'm the partner. I will help if I need to, but I'm limited in not the value I add in the day-to-day, but really attention span, focus,
time,
and reps. I don't get a lot of reps negotiating contracts anymore. I probably could. You could probably go help with the construction aspects of things, but it's definitely not a good use of your time.
Yeah, no, I agree.
So as we come into close, like one of the things that because this is, hopefully this has been a fun conversation for you.
For sure.
I've enjoyed it. But like, what is advice that you would give to the everyday investor? It doesn't necessarily have to be mobile home specific or real estate investor or RV specific. It doesn't even have to be anything on topic. But like, if you were just talking to investors, what would you tell them?
I feel like it's going to be super cliche because you hear this because it's really should be common sense, at least in my eyes. Like if I'm going to give my money to somebody, and I guess we're talking as like an advice for an LP investor.
However you want to take the question.
LP investor, or it could be, I mean, I don't know what your audience, if it's more active.
All of it.
Yeah. Yeah, I would say for an LP investor, again, this is going to sound cliche, but again, it goes back to track record, right? It goes back to the jockey. And I think, just avoiding the shiny object syndrome. Like our deals, we have solid returns. You've seen the returns, right? We have solid cash flow payments every single month. And there's guys out there that are advertising stuff much greater, the 27% IRR, but they're not comparing the risk profile of those two deals, right? And so for me, it's for an LP investor, it's kind of cookie cutter, but the jockey, right? The track record.
You're the jockey in this scenario.
In this scenario, yeah. But so
there's no horses on the screen or anything, but he's the jockey.
So yeah, but it's the track record. Have they gone through the downturns? Have they been through COVID? Have they been through interest rate hikes? Would be important to me if I was giving Tim capital as the operator of the GP. For investors, just guys that are watching this on your channels, I think it goes back to finding something that you're really passionate about, branding yourself as the expert, subject matter expert on that specific topic there, and just really going after it. If it's somebody that's a new investor, people always ask me. I tell people I just released an Instagram video. I think it dropped today from our team, but for these guys that want to be new investors, I get DMs every day. How do I become a real estate investor? Right? Such a vague question. How do you answer that? And I launched a video today. I'm like, man, you guys are asking everybody to be your mentor, but you need to come to them with what kind of value you're going to bring to their organization. And it's not just a handout, So I said, hey, go work for free, right? If you want to flip homes, go talk to the guy that's crushing it with flipping homes. Say, hey, here's what I can do. I've got XYZ skill set. I'm badass at social media. I actually can paint. I can, whatever it is. But you have to bring value to somebody before you expect them to pour value into you, especially a successful real estate investor.
I actually, to that point, I crushed somebody's dreams the other day. I was at a networking event, and this woman, mid-20s, MBA student, and was like, "Yeah, I want to get into real estate." "Oh, you do?" She's like, "Yeah." I was like, "Do you watch videos on YouTube?" "No." "Do you go to networking events?" "No." "Do you read books?" "No." "You don't want to get in real estate."
Right.
She's like, "What do you mean?" I was like, "If you wanted to do that, you would go to events, you would read books, you would watch videos on YouTube. All this stuff is online. Watch content, learn it. But everybody wants that easy path. They want somebody to like, here Tim, let's do this thing.
I had
versus,
no idea what we were about to do.
Yeah, where are we going?
I'm saying like they want somebody to grab their hand and pull them versus like just go do it yourself.
Yeah.
Go watch a video, learn it.
Well, one of the strongest things Marcus just said, and I know we got to wrap up, track record. I say it all the time in every room I'm in at any place, especially new investors. They got to be careful. Your track record is the one thing that is unique to you, and it can never be restarted.
Okay.
Like a failure is a failure, and you're gonna own it the rest of your life, right? A success is a success, and you need to get better at documenting it and sharing it, because you may not want to raise capital now, but you could later. And if you share your story and you show your reel and document your track record, it makes it a lot easier for someone to trust you, and oftentimes I've found seek you out to give you money when you're not even asking for it. We were talking about it on the elevator up here. I have more offers of people wanting to invest in Ternus than I could deploy in the next year. And it's a great position to be in. And it's just by sharing myself openly and freely. And the last thing Marcus said, I will say this, specifically if you're evaluating a third-party investment in today's market, look at their recent track record. If it's a multifamily investor, you need to get the trailing 12 income statements, the T12 as they call it, of their current properties. You need to look at their current investment projects and see if they're paying their investors.
Correct.
And what they're paying their investors. Because I'm in a lot of deals right now where the projected IRR was 18 and the annual cash flow was a 6 or an 8, and I haven't received a check in 2 years.
It's accruing.
Yeah, it's accruing.
Yeah.
Well, in the wrong way.
Yeah.
It's accruing for sure. But the point is, there's a lot of smoke and mirrors out there, and there's a lot of people that say what they've done, but what they're saying needs to be substantiated in writing from a third party before you part with your money, because you know what's the old saying, a fool and his money are soon parted. So don't be a fool is the advice I have. Like a guy like Marcus, I like him, but when he's telling you about the other parks he has right now and what he's paying, ask to see the information. Ask for the information. Ask for the proof. It's not enough for someone to tell you what they've done. You need to know what they're doing in today's market, because the real estate industry is in a lot of trouble, and there's a ton of opportunity if you get with the right people. If you get with the wrong people, your money is going to the people that are about to sue them, and that's just the way it is.
Solid. Thanks for watching, everybody.